It's the afternoon of Monday, May 1st. We're recording on another historic day. First Republic, a major U.S. bank, has fallen, taken into receivership into the Federal Deposit Insurance Corporation, of which JPMorgan has come to the rescue and bought the majority of its assets. I am joined by two experts on banking, Chris Whalen and Randy Woodward. Gentlemen, great to have you both here. How are you doing?
Another day in paradise.
Chris, you've got a piece out on your institutional risk analyst today talking about the false narrative on First Republic Bank. We've got a lot of narratives about First Republic Bank. What is the false one?
Well, that they could sell the bank or raise capital for the bank or sell a large chunk of the loan portfolio. This was, there were several threads out there over the last week or so. But bottom line was anybody who looked at this bank and looked at the coupon, the average coupon on the loan book was about 3.25%. The industry is in the fours on average. So that told you that this loan book was going to go at a discount, 10, 15%. And it wipes out the bank's equity. So that really, to me, is why the FDIC had to step in, take over the bank. They sold most of it to JPMorgan, as you pointed out, and then some other bits were left behind, like the preferred. So that's the power of the FDIC receivership. Essentially, everything Jamie bought is brand new. There's no legacy claims on it.
Chris, I noticed, yes, Bear Stearns, even though it was bought at a pittance by JPMorgan in 2008, its preferred shares were, I believe, taken in at par, converted to JPMorgan. Not so in this case. I think it's fair to say that not only is the common equity a bagel, aka zero.
Yeah, I think the entire equity capital structure got left behind. I don't know that there was any debt assumed. I don't think so. I didn't see that in the press release.
It said no debt assumed, yeah.
Yeah, I think it was just deposits. FRC was a unitary bank. So whatever was left behind is just literally left with the old corpus, the old corporation. And then the new stuff was sold to JPMorgan with a zero cost basis. Pretty cool.
Randy, you've also got some language on your note today. You say that First Republic was a sort of a corpse that was taken over by JPMorgan. What did you mean by that?
It was euthanized. I mean, I think it was, you could say what you want about their model. And this is why I was excited to talk with Chris, is to run some of my thoughts past it. But there was nothing wrong until all of a sudden everything was wrong. And in my opinion, once whoever decided that the sole reason Silicon Valley Bank failed was because of uninsured deposits, that was the primary reason, then all of a sudden, who's next? And I feel like I haven't seen anything that First Republic did that was really bad. I mean, maybe not, some of it wasn't the best ideas, but nothing that it should have just exploded like it did. And so I guess
it was one of these business models, Randy, that kind of did okay over the past 10 years. But 10 years before, would they have been able to do this? I don't think so. It looks like they were making most of their money selling mortgages. What do you think?
I saw their loan book, bond portfolio, which of course that was the problem with Silicon Valley Bank. Oh my God, the unrealized losses and, HTM and AFS and all this jazz. And I'm like, you're not even thinking about the loan book, And so now here we have an example of a bank that you're forced to sell your assets. That's the end of the game. It's a simple bank run. That's all it was. It was I think, a senseless, needless bank run on FRC anyway. And I think others
it's an outlier. Don't you think all of these are outliers to one degree or another?
And my concern, Chris, is the market's going to look for the other outliers, right?
Yeah.
They're going to look at,
agree.
And I almost don't even want to say what they are with First Republic because I don't want to promote that. Yeah. But I would say the one that's going to be an issue, and I know you've talked about it, and Munger talked about it, I guess, over the weekend. Somebody heavy in CRE office is they're going to have a problem coming up pretty soon.
Yeah. Well, they all have senior exposure to, CRE office or JPMorgan.
Yeah. It's the percentage, the level of it, I guess is what,
the bondholders will get toasted first. But in the case of the really radical change in business case for some of these assets, that may not be enough, and the banks may take a loss too.
Yeah. Well, that's my point. I just think this is outliers. That's what people are going to start looking for. And that's why it's very calm right now, right, Chris? I'm not, Pac West is hanging in there. They're not, they're the lowest they've been. They're 907 right now, but
their deposits went back up from,
yeah. So hopefully we can calm down. I'm more concerned about, okay, what's the next target, and that's what I'm waiting for. And that's why I'm watching what people are saying about First Republic, because then that'll put the focus on other banks, I think, again, senselessly.
Well, I wrote about Bank OZK, Bank of the Ozarks, and they've actually managed to grow deposits because George is a smart guy and he repriced his book. He went back to his customers and said, no, we're raising our rates, and they have to do that. Yeah. So I think the banks that are willing to do that and that are willing to take stuff to the curb if they can and sell it so they can redeploy that liquidity and higher yielding assets. Those are the survivors, guys. I think everybody else has got
But that's very difficult, right? I mean, your assets are stuck, and I've seen as low as 250 to 350. Maybe you got some that, when I'm talking total average assets, you're going to reprice to what? Is 2 enough? Is 2.5 enough? I think the bleed is going to continue to happen. And that's the thing I wanted to say. I guess I knew FRC was done because we looked at their net interest margin that fell from 245, I think, to 177 or something like that. But I was like, but that was one bad month and 2 good months. Now we're going, with the 100 billion borrowed at probably 450 to 5%. I don't even know. They were going to go under 1. They were going to lose another percent, and you can't operate a bank that way.
Chris, they made a bunch of mortgages to very wealthy people who had mortgages at very low coupons, 2.5%, 3%. So they were earning very little on those things. Low credit risk, they're going to get paid back, but not earning that much. However, their cost of deposits,
idiosyncratic loans, they're custom, private label assets. So to finance that kind of production today, you're going to pay 7.5. That's your cost.
7.5 to finance jumbo loans
for warehouse for those non-agency loans. Those are private loans. They're going to go to a bank. They're going to go to a private investor, where the bank would retain them.
But isn't the credit quality such of those, basically no net charge-offs?
But they tailored those assets to the clientele in order to retain them. Your typical asset management client, those guys get picked off in 6 months or a year because somebody calls them up and says, hey, I got a really great idea. Let's refinance your mortgage. And it disappears. So the bank that made the first one doesn't even make money because they haven't recovered their fees yet. That's the kind of business it is. So to retain those people, you got to be really nice to them. You're not charging them a lot for the asset management, and you're making money selling jumbo mortgages that, Citi and JP are helping you finance.
So you would not believe how many investors I've met over the past month who've said, I bank at First Republic and they've got the best customer service ever. Oh, yeah. And it's like, they give you a mortgage at 2%. I believe it. Yeah. And that's part of the problem because they weren't earning enough on their.
I want to know what Randy thinks about this, but the book was pretty tight at 3.25, don't you think?
Yeah, I mean, but is 375 is 4 the right number? It's an outlier.
Peer group one is. I want to see it. It was 420, I think, for the average for all the big guys. All right, 4%, but 4 still is awful. I agree with you.
Well, I'll tell you, in community banking, and to be sure, I'm strictly community bank. I'm 10 billion and under, so that's my site, coast to coast. Is all 10 billion and under, and in the 3s is fairly typical.
Well, for your mainstream guys, George Gleason at Bank OZK is at 6, but that's high touch commercial.
Yeah, I want to see how OZK gets through this with all. That's a lot of construction loans, right?
The question is it better to do development and construction? In other words, focus on the front of the business and not hold the end piece mortgage.
Yeah, I'll tell you this. My thought on that is, throughout my career now, and again, I always have to explain, I'm a bond guy, so I look for bad things first. Equity guys look for good things first, and then, well, what might be bad? I'm like, what kills me here? Okay, if I can get past that, then now I'll start to see what's good. If the thing I've seen through my career is if you're leaning one direction, you end up usually getting caught. FRC, Silicon Valley, they leaned into huge depositors with a ton of uninsured deposits. That clearly was a bad lean, right? So if you lean into subprime lending, the IndyMac, it ended up to be a problem.
The clientele at First Republic is not Schwab. It's not Ray J where you are.
Right.
You know what I mean? It's a different kind of relationship with that customer.
Yeah. And they just, and the thing that I liked that you said most when in some podcast you did, you said, really what we need is time. We just need time. And those banks ran out of time. Most banks just need time. They have the time. It'll work out.
Well, the Fed could repo all this stuff at the coupon rate, okay?
Yeah.
At par forever. And just wait. Other than that, to give me back cash that I could then reinvest at 6 or 7, that's, to me, the only way to fix this, because otherwise you have a sale. And if they sell, then they get the loss.
I just think in the end, the Fed's got to cut. That's really the only time and cuts. We need both of those things because it's going to get, and this is going to have ramifications. I think that's what I wanted to talk to on that podcast you and I were on. We ran out of time, but the idea that this is just going to go away is absurd.
No, it's just cash flow. It's cash flow.
But credit's going to change. Credit availability is going to come down.
Already has.
It has.
Everybody you talk to, I'm sure, has stepped back.
Absolutely.
Cash.
Absolutely.
All right, yeah, guys. So was going to jump in to explain some terms, but I'll do that later. In terms of credit availability, what are you hearing, Randy? Let's start with you. Are banks making fewer loans? So how much has it gone down?
Let me explain how this works because I don't think a lot of people know this. And this has always been an amazing thing that I've seen in my career. When I'm in an executive meeting, we now have a competition, a battle between the senior lender and the CFO. The senior lender makes his money doing loans. The CFO makes his money making sure they don't screw up. The senior lender usually wins. Okay. So my CFOs are usually, those are the guys I'm talking to. They are all wanting to shrink. They are all going, we have been trying so hard to grow it too fast, too much, now we see the negative impact of that. And they want, as cash flow comes off, whether it be bonds or loans, they want to pay off borrowings and they want to shrink and they want to get more manageable. And the battle is the senior lenders. I don't know who's going to win. I just feel like the forcing is going to be less credit availability, but the battle has begun internally in these banks.
Well, because they have to make a choice. You can't just cut everybody back 5%. You're going to drop lines if you want to really step back. And that means that LO is going to make a tough choice. We've been watching for that in the mortgage space. Fortunately, volumes are down. So the utilization rate on most lines is down. And in fact, lines have been getting dropped because they don't want to pay the fee if they're not going to use the line, right?
Yeah.
So the leverage is still kind of on the side of the borrower right now. They haven't had to worry about it. But, the credit's clearly tougher and the spreads have been getting pushed out.
Yeah. And that's a process. Again, there's a lag to that, but it's going to have, and look, everybody's getting beat up on duration. So they're going to shorten duration. Yeah. I don't know who's going to buy,
but to me, the most striking chart that we've had in the blog in a while was when I found this great Bloomberg chart that showed their duration index for Ginnie Mae. And it clearly shows that the Fed was using forwards or TBAs to push down duration in 2019 because Powell panicked.
Yeah.
And they thought, oh my God, we can't have another money market crash. So they threw all this money at it. This is the big debate among economists now, abundant reserves versus not so abundant, right? And I think Powell's going to have to come and fess up. There are members of Congress, this fellow Scott, has been asking some pointed questions. So we'll see.
Some of them know.
We don't want to talk about this right now. That's for sure.
Well, my question to you, and you might know this more than I do, but the one thing that I think was really egregious by Powell was, okay, you got to go to zero because of COVID, which we're probably heading there anyway, because 19 was not going well. I mean, we were
right.
headlong into a recession. But why did you bail out mortgages? Why did you take, I forget what the coupon was, probably like a Fannie 2.25, 250 coupon. Why'd you take it from par to 105 in a week? Why'd you do that? My banks had a ton of cash to invest. They're going to get a bunch more because of stimulus. The buyer was there. But why did you have to crush mortgage spreads? So who were you saving?
I think they were making it up as they went. They were trying to guesstimate how open market intervention should be equated with changing the target rate, right? And they have no way of doing this. I've talked to a lot of people at the Fed and the banking, and they just guess. So they come up with this stuff, and they were also terrified of COVID, remember?
Right.
Yep. The supervisory staff told everybody to put aside, $60 billion, which they didn't need. So that skewed all the financials for you guys. They were fighting the last war, but then they chose to go big, thinking that ample reserves would solve all sins,
Yeah.
And it's created a huge problem now. It's tied their hands fighting inflation, and it's left the banking industry insolvent, like you said. So if we don't drop rates, 200 basis points probably.
But they amplified the problem when they bought mortgages. I still don't understand it.
They should not have done it. They figured they couldn't just buy treasuries. They wanted to go big, right? Yeah. And I think there was also an element of wanting to help housing, quote unquote.
Well, it did.
Well, it sure did. But it's the worst duration extension trade in history.
Yeah.
It's a disaster.
Yeah. And that's going to have ramifications. I mean, that the flow of money is going to be so much slower for a really long time.
Well, and also all those lenders, think about this. I just did a piece on Penny Mac and Mr. Cooper. Mr. Cooper is happy with a book that has low coupon rates because they want to keep the asset forever.
Yeah.
And they realize that 3/4 of all 1 to 4 family mortgages are now below 4.5% coupon, right?
Yep.
So those mortgages, I have a 3. Those mortgages are not going to come up for refinance for a long time, and the people are going to stay in those homes.
I just want to define a few terms. Chris, you said that Mr. Cooper, financial institution, they want to hold those mortgages. I think, Chris, though, the issue isn't wanting to hold them, it's being able to. I think, Silicon Valley Bank, they wanted to hold them. First Republic, they wanted to hold them, but just there was a...
This is mortgage servicing. This is different.
Okay.
They're keeping an annuity. And because the likelihood of prepayment of the mortgage that's tied to the servicing right is very low, it's basically investing in a bond that's got a very low prepayment rate. Those mortgages are that right now, the actual prepays on Ginnie Mae 2s and 2.5s is down around 1 or 2% annualized. That's extraordinary.
You got a mortgage at 3.5%, and now interest rates are 7%. There's no way you'd ever want to, unless you have to. But
that's right.
And that'll change. Just natural attrition, to be sure. Death
for the old-fashioned firms like United Wholesale Mortgage and Penny Mac and those guys. The fact that the Fed refinanced all of those mortgages during 2020-21 means there won't be a lot of business to be done.
That's right, too.
And it'll be, we pulled those sales forward into 2021, and now they're not here now. So we're going to be lucky to do $1.7 trillion this year in mortgage issuance.
We're never going to see that again.
We did over 5 in 18 months.
Yeah.
Crazy. But that's what the Fed did to the market. So structurally, the term structure of interest rates is now compressed into that little range. So you can't move rates very much. You've made it impossible. And that same characteristic, by the way, is in the bond market. It's in CMBS and all of these commercial assets that Randy was talking about before.
Yeah.
So take your pick, I think the commercial is going to hurt more this year in terms of credit.
I think
commercial and industrial or commercial real estate?
Commercial real estate. Yeah. Commercial industrial is a different beast.
I don't think a lot of people understand how commercial properties are priced. They're not priced because they're in the Hamptons. They're priced because of the income flow. And if that income flow hasn't changed much and now your cap rate is double, your property is essentially worth half. So obtaining the debt to refinance the debt is going to become the big problem here. It's happening right now.
Well, we'll extend involuntarily.
Exactly.
That's what we'll do.
Exactly. They'll do that, and the regulators will only, from what my guys, it's not my division, but the guys who do that say they can extend 12, 18 months, but the regulators will start saying, no, enough's enough.
I just want to ask about the fundamental problem banks face of loan yields have gone up, but they haven't gone up as much as deposit costs for many institutions. And Randy, earlier you talked about the net interest margin, and that's the spread between what banks pay of depositors and other people who supply capital, cost of funds, and then what they earn, their loan yield. So First Republic had ultra low loan yields because they were lending mortgages to people who had a very low default risk, and in some cases they were making interest only mortgages where for the first 5 years, the first 10 years, no principal payment, only interest only payments. I mean, in terms of a cocktail of duration sensitivity, that's pretty much like you're owning a lot of TLT out there. You're not getting paid. You're not getting paid now. You're getting paid well in the future. And when interest rates rise and the cost of future cash flows is worth far less, that's a big cocktail. Randy, how much can we put this at the feet of First Republic themselves of making these loans that had tons of duration risk? In the same way, Silicon Valley Bank, they made a lot of these loans as well and did not hedge them. And I can ask you about the Federal Reserve's BAR's report on Silicon Valley Bank, which showed, in my opinion, multiple failings.
Everything I've seen in there, every bank is in the same boat, to various degrees. Are they at 350? I think some banks are lower. So it's like, are they really that much of a standout? And on the hedging, everybody thinks there's some sort of magic hedging panacea. It just doesn't exist. So that's not really.
We don't hedge portfolio anyway. You keep that on credit.
Yeah.
People have this crazy idea that you hedge the whole book. No, you don't do that.
Yeah, if you hedge the whole book, you make no money. End of story.
Right, but they had
trust me.
Silicon Valley Bank took the hedges off the available for sale in March of 2022, which is the exact same month that Powell started raising rates. So
they had a profit on it, and again, it wouldn't have made that big a difference. It's a mitigator.
A small securities book, like you said, Jack. It was pretty typical. What was not typical was that they were keeping all that home cooking on their balance sheet.
Right,
all those private label loans. And they would sell them too. To answer your question, they made money selling loans. They had a nice gain on sale.
So let me ask you, Chris, because I didn't know that until I read your piece this morning, which, by the way, Yellen would be in the same position. So I totally disagree with Adler giving you grief about. I was like, right. I'm like, look, she got the perfect timing and got out of Dodge, and Powell got stuck with all the bad stuff. But so is it possible? I didn't watch over the last 2 years. Did First Republic just run out of people to buy their private label production?
Well, the market certainly slowed down when rates started going up. You can see it in the SIFMA issuance data. It just kind of went into the ground. And I think you also had fewer mortgages being originated. And what happens in that market, the good stuff stays with the banks. They just keep it. They keep the servicing, they keep the note. And then the other stuff they sell if they can. But that dries up too. So you can see it in the volume numbers. Most of the REITs in that space that traffic in this stuff have had to, diversify and get into other asset classes just because there's nothing to buy.
Chris, you're talking about mortgage REITs.
That's right.
Which buy loans, not they don't buy buildings. They buy mortgage-backed securities and some
that's
cases.
Right. There's three basic types. You have the guys who buy commercial real estate equity REITs. You have the agency REITs that buy liquid securities, mostly Fannie, Freddie, Ginnie. And then you have the hybrids that also buy servicing. They buy all sorts of cats and dogs, business purpose loans, the whole bit. And, there are some very adept players there. These are smart people. They primarily fund in the equity markets. So it's kind of like a fixed income product. But, they live and die on the yield curve too, and they will live and die on commercial. There's a lot of private REITs that hold commercial exposure that you've never heard of. And they're going to take their lumps in this cycle, very definitely.
Yeah.
So,
And so, Chris, as a banker, if you lend money to someone and they don't pay you back, that's a risk. That's like the number one risk. But there's also the risk of, if they do pay you back, interest rates rise and that cash flow is not worth as much as it used to be.
right.
Is a learning here that maybe the banking system, having had essentially declining interest rates on a long-term time horizon for 40 years, isn't taking seriously or wasn't taking seriously either in practice, behavior, attitude, regulation, just that risk of 500 basis points in a year?
Well, I think that whole aspect of this and the Fed's responsibility for their actions is extraordinary. You can't really blame this on bankers because they can't adjust that fast.
That's
It's just
my
not
opinion.
possible. The average life of your bigger banks is probably inside of 5 years. So you figure that 20% of their buck's going to roll off every year. That's how fast they can adjust, if they're lucky. You have other banks that are much longer to keep everything, like Bank of America is probably close to 20 years because they keep 30-year mortgage paper on their books. So, each bank is different in that degree, but all of them have the same problem. That's the issue. Whether you blame Yellen or you blame Powell, I think the hubris they showed and the lack of, purpose in terms of understanding what would happen if they did X, Y, or Z, that is what's really troubling, because there's a lot of good banks out there that are going to take a kicking because of this environment. And those are people who did nothing wrong. They're just dealing with the fact that somebody in Washington decided to experiment on them.
That's exactly what happened. Yep.
Because think about it, if we haircut 2021 production, which is like $25-30 trillion, we probably have $5-6 trillion worth of losses. The banking industry can't absorb that by themselves. So that, and pension funds, everybody else out there shares a piece of
Insurance companies, there's
Can it be funded by the depositors not getting market rates over the next 30 years? In other words, depositors will get 1%, but the risk-free rate is 4%, and that will help the banks make the money that they need to make up for having lost money on the loan.
Well, that's a gruesome prospect.
Well, there's some level of sticky deposits. There's
Right.
I've back when rates were 5, 6, 7% savings rates. This is a while ago. And I had a buddy or a partner I worked with who he had a bank with a 0 deposit rate. I'm like, how's that possible? It was like in Palm Springs. So there's these rich people that want cash at their vacation spot. So they just left in it. They don't care that it's 0. They just want to know that if I'm there, I can go to an ATM or I can go to the bank and get cash. So, now this was pre-phone, right? This was 20 years ago, but there's always going to be some level of sticky deposits, but they are all having to raise them for sure. That's not going to stop. There's going to be a slow bleed of deposits.
You're right. And tell me, what are you guys seeing on the deposit front? Because, okay, we get it. The bank made $100 billion in mortgage loans. The mark-to-market value of that is now $82 billion, $18 billion hole. That's a problem. But that hole only becomes a real problem when people start pulling their money at depositors. And if people keep their money there, it won't be a problem. That's a problem with Silicon Valley Bank, now First Republic, which, by the way, Silicon Valley Bank, Chris, no longer the second biggest bank taken into FDIC.
No.
Now it's First Republic, so it's bumped down to number 3.
Yeah. Well,
What do you see on the deposit front? Because Bank of America, all these huge, globally systemically important banks, money flowed into them out from some of the regionals into them. So we actually saw a reacceleration in deposit growth from Q1, back from the fourth quarter. But then some of the regionals as well, Western Alliance, PacWest, their deposits went up from March 2020, March 20th, 2023, around mid-March, when you had a huge outflow, the deposits went back up. So there's a lot of hope there. So what do you sort of think, Chris?
Well, it's not hope. It's that they are managing their business in such a way that they can price those liabilities and retain them. See, it's not big or small. The banks are all competing with the Treasury. They're competing with money market funds. and they have to reprice to compete with them. That's it. The ones who can't do that are going to end up having to sell or get bought involuntarily. You know, the Fed is not giving you much choice unless they drop rates. You know, if we keep interest rates where they are all year, we're going to have the average cost of funds for U.S. banks up close to 3%. That's like a 200% increase from where we are now. So
raise loan yields, increase the cost of credit.
Yes, you will.
Those are coming down. I mean, there's going to be less loaning to be done.
That's right.
You know, it's just right. we especially in housing, you know, and you know, and as we said, you know, if you got a commercial real estate and the loan comes up this year and you're going to double their interest rate, they're probably not going to be able to do it because they're going to have to show up with an enormous amount of equity to pay that loan off and refi. It doesn't work. So they're going to delay that, meaning they're going to keep that loan yield on the books longer because that's better than default and taking the building and trying to figure out what to do with it.
Oh yeah, especially in places like New York and San Fran. You have tenants walking away from assets now.
Yeah.
And the manager of the asset is going to turn to the mortgage holder and say, hey, what do you want me to do? The building's empty. Okay. Yeah. And people have seen this coming, but it was COVID that accelerated it. Yeah. This change in behavior is, episodic. How do you even describe this? And I think it was just pent up. People wanted to change how they lived. Yeah. And COVID gave them the opportunity to do it. They're not going to go back.
And all my clients are trying to get some, people back in there. Some, it doesn't have to be 0 or 100%. All you needed to do is come down some percentage, and everything has to be repriced.
Oh, that's the thing, because as soon as you reprice, it rolls through the building. All the monitoring services see it. The rent rolls and everything else, the taxes, and the asset value goes down. And then the bank shows up and says, hey, you got to put more money in.
That's right.
To keep it at 50 LTV.
I don't think that's so I'll try to get a real quick number. And this is super simple, but like if I got a 2 million building and I had like a, 5% cap rate on it, 5 years ago, and I come in and I got a 70% LTV. So I got $1.4 million loan on this $2 million building. And
you're making $100,000 a year.
Precisely. Yeah. So now I come in, what's the cap rate? Well, it's 10. So now your building's only worth 100. So now I can only give you a loan for 700,000.
Yeah, now it's only worth 1 million. So your loan's only worth 700,000, and that's a loan to value of 50%. And Randy and Chris, this is something that looking through the balance sheets of the banks, we listen to all the podcasts about everyone's bearish commercial real estate. I make some of those podcasts. I get it, but looking through the balance sheet of the banks, 40% loan to value, 50% loan to value, 60% loan to value. They seem pretty conservative. Are they not as conservative as
Well, the smarter lenders tend to be very conservative because they know that anything over 50% is not real. Okay. Now some lenders may find that too aggressive, but the smart people I know in commercial, they view the top of that stack as speculative.
But I think a lot of them are 70, a lot of them, and even 50 is still going to be, you're still going to have to show up with equity. I mean, the fact is your rate's going up and it's the cap rate's the problem because I can't give you as much money on this property as I could before.
That's right.
That's a good point. I didn't think about that.
It's not just a matter of the lender not wanting the asset. It's just that they're going to be forced to stretch terms. They're going to be forced to go back to the examiners and say, hey, I've got to give so-and-so better terms. I can't get 50 LTV. So those assets will all get special mention and they'll go into the little, bad bucket. And they're not really financeable long-term, especially in New York City. The rent stabilized stuff that Flagstar didn't want to take from Signature Bank, it kind of typifies this. And these assets are impaired. There's no other way to put it. Until we get different policies from some of the politicians in New York, that market is in serious trouble.
Yeah.
And it's sad because you know what? For 50, 70 years, that market was perfect. All the regional banks in New York City banked all the multifamily real estate. It was always fully let. It was a sterling asset.
people are fighting not to go back. And I've got friends who are up there, and I've offices of people I know. They're like, we just can't get them in. People are just absolutely refusing.
Well, I do two days a week. I'll go in tomorrow.
Well,
I just want to get to the nuts and bolts of the terms, and I'm going to read out a few things of JPMorgan's purchase from the FDIC of First Republic assets. They bought just over $200 billion worth of assets, $173 billion of loans, $30 billion of securities. They assumed $92 billion of deposits and $28 of Federal Home Loan Bank advances, so just over $100 billion in liabilities. Did not assume First Republic Bank's corporate debt or preferred stock. They're going to make a payment to the FDIC, JPMorgan that is, of $10.6 billion. The CFO said $2.6 billion on the call, and he had to be corrected. Let's see. FDIC gives them 80% loss coverage for 7 years on residential, for 5 years, 80% loss coverage on commercial loans. I'm wondering, is that on credit or only on credit, or on interest rate risk is too? Just on credit?
Cash losses.
Cash losses. Okay, thank you. And then, but they bought the book at a big discount. So they bought $173 billion of loans, but they got it at a 13% discount. So they made quote $22 billion. But my question is, what percentage of those loans? What was the sort of mark to market value? Randy, you're a bond guy. You've been in the bond business.
I think it's pretty close to fair value.
Close to fair value. So it's not like they bought a dollar bill for 50 cents.
I don't think so.
No, I think, 14, 15% discount is what you said. That's in the ballpark without looking at the loans. You're just thinking price, because the average coupon on that book was 3.25%.
Right.
So that gives you a sense for kind of pricing.
Yeah. Okay. So then how do they said that the market and everyone kind of says this is a really good deal for JPMorgan. And I'm not saying it's not, but JPMorgan assumes a internal rate of return, IRR, of over 20% for this transaction. They've got a one-time gain of $2.6 billion. So where did they get that 20% internal rate of return?
Who knows? We can't tell you.
Okay.
Yeah.
Well, Jack, you mentioned it on your site. I'm curious about, Chris, correct me if I'm wrong, but this weird $50 billion loan that they got that they won't disclose what the rate was. What was it, a 5-year loan, fixed rate loan? The
$50 billion 5-year fixed term financing. I don't know what that is, but they had. I know they had close to $77 billion in Fed liabilities, some in the discount window and some in the bank term funding program. So maybe it's that.
What you can know, Jack, is that the number will grow. The loss to the FDIC will go up. And, how this is all resolved, JP owns these assets, so you're going to only get what disclosure they give you. You're not going to see it on the FDIC website because there's not much left in the receivership. But these particular assets, they'll have to tell you how they work those out.
Right. So FDIC estimates that the cost to the Deposit Insurance Fund, the DIF, will be about $13 billion.
Yeah, that's
it's an estimate. Final cost will be determined when FDIC terminates the receivership.
Yes, it'll be higher.
Yeah.
So,
Chris, I know there's some rule maybe from the OCC saying that huge banks like JPMorgan really shouldn't own or be able to do these transactions, but that exemption was lifted because that's what JPMorgan said on the call. It was the cheapest transaction to the DIF, and the DIF is the FDIC's fund.
right.
What would you have a sense in terms of what that bidding process was like? Because Chris, okay, so exactly 1 week ago, First Republic reported their earnings report. It was an absolute disaster. The stock got smoked probably 40%. The next day, it got smoked 40% again and again and again. Going into the weekend, things looked pretty grim, but there was the rumor of a bid, and it was a very ambiguous language of they could buy First Republic, implying, a Bear Stearns, they're buying the common stock, they're assuming the preferred equity. But this is not what we got. But is this a failure in the same way as Silicon Valley Bank, or a takeover?
Well, everybody gets tangled up in the terminology here, but the bank was declared insolvent by the state of California. It passed through the FDIC receivership, which basically means the old corporation stays behind. And all the assets that were sold to JPMorgan were put into a new company and then delivered to him, right? So, that's how it works legally. All the claims stay behind. If you had a claim against First Republic, it stays behind. and will die in the receivership. You may get a recovery, but it's unlikely.
Yeah, and so did this all happen on Sunday? Because I know there wasn't really any news. It was this reporter heard this, this reporter heard this, but nothing a hard copy until, this morning, really.
No, and that's the nature of the process. When they actually pulled the trigger, doesn't matter. They will fill out the documents, and that'll be that.
Yeah,
I was
you paper after the fact.
I was surprised it took them that long to come up with something. It seems to me usually.
Well, I tell you had a busted process. That's what it told me.
Yeah.
How was it a busted process, Chris? In what ways could it have been better?
Well, nobody wanted it unless it went through the receivership.
Right. That's it. Nobody wanted it.
Yeah, that's it.
They had to find a way to.
Beating this one to death, Jack. I am going to say goodbye to you.
Yeah.
And thank you for the time. And we will talk again soon. All right.
Hey there, sorry to interrupt. Announcement. Blockworks is hosting an event called Permissionless in September. It's a crypto event. It's in Austin, Texas. We did Permissionless in 2022. It was the biggest and best DeFi event in the world. And this year, Lightning will be striking twice. Historically, our ticket prices have gone up about 10 times from the day the tickets go live to the day before the event. If you're like me and bad at math, that's 900%. So it might be savvy for attendees to consider buying tickets now rather than later. If you're listening to this and you're saying, hey, Jack, I'm not really into this whole crypto thing. I want to hear about the Fed. I want to hear about the dollar, Bretton Woods 3, 4, 5. I hear you. I'm not telling you to buy a ticket, and the interview will resume momentarily. However, if you are into the crypto thing and Permissionless is something you might want to attend, what I'm saying is there's no time like the present because tickets will go up, and if history is any guide, prices will go up a ton. Anyway, the link is in the description, and you can get an additional 10% off by using code GUIDANCE10. Thanks. Let's get back to the interview. All right, Chris had to leave, but we're still here with Randy. And Randy, I just want to talk about the degree to which you and other people may hold the Federal Reserve to blame for this, blaming this on the rapid rate hikes, blaming this on quantitative easing and then quantitative tightening. I feel like the audience kind of wants me to push back on a little bit. And, I'll be polite and stuff because I definitely think a case could be made that, some of these bankers made a lot of big mistakes that Jamie Dimon didn't make. And if you make a mortgage at 2% and interest rates go from 0% to 5%, it's kind of it's the law of the jungle. But first, Randy, could you make your point in sort of why you hold? Because it sounds like you kind of agree with Chris's point. You and Chris hold the Federal Reserve accountable for a lot of the ongoing issues in the banking system.
Yeah, I think the first thing to try to understand is that JPMorgan's not a bank. It is a massive conglomerate with all sorts of businesses, all sorts of profit centers. It isn't just a traditional, George Bailey, bank. It just isn't that way. But most regional and most community banks are. It's a very simple model. And, you go into, and I mentioned it when we were talking to Chris, you go into 2020 and they take rates to zero. Okay, whatever, I guess you had to do that. The problem that I have, and leading into your answer to you, is that they bought also mortgages. And I didn't really understand why they did that. And they crushed mortgage spreads because my clients had a ton of money to invest. They were about to get a ton more money to invest from all the stimulus. And at the same time, we knew because they had done, taken rates to zero, mortgages are going to refinance. So all my assets are going to reprice. And that's what happened. 2020 and 21, they spent most of those 2 years saying lower for longer. I'm not even thinking about raising rates. And what is a bank to do? You can't just sit on cash. It doesn't work that way. You got to invest that money. And, when am I going to go into a 1-year treasury and make 5 basis points? No. I think the 10-year, got down to what? Below 1%.
Yes.
And so you do the best you can, and you go into, mortgages where there is some spread. Now there's duration, and that's more of a longer story about how you pick the bonds, the mortgage pools that hopefully will always generate cash flow. So even if, rates do go up, people still can't death, divorce, default, you're still going to get your cash flow back and you'll reinvest it at those higher rates. That's what a bank does. It manages cash flows. But this was such a severe, virtually all my assets repriced at the lowest yields in the history of man, 20 to 21. And then you take my funding up by 500 basis points inside a year. There's no way to just, and there was no way to prepare for that. Even when they finally said, we're going to start raising rates, it's too late. I got all my assets and who's going to buy those when, we're going to raise rates? Nobody.
A lot of people criticize the Federal Reserve and for many different things. They criticize the Federal Reserve for not hiking. Then they criticize it. Rates are too low. Rates are too high. It's like everything is the Federal Reserve's fault, and I'm not saying it isn't. I'm not saying it isn't the Federal Reserve's fault, but what would have been a pathway for the Federal Reserve that would have caused less chaos in the money markets and the banking system?
Well, I don't think they should have bought mortgages for sure. I just, there was so much money in the system. I don't know why. That's my big question to anybody that may have an answer. Somebody, we don't know who it was, back in March was selling mortgages like crazy and the prices were tanking.
Yes.
And my clients were buying. It might have been, if I remember, I think there was talk about some huge CLO losses overseas. And if you got losses, you got to make up for it. You're going to sell good collateral at profits. And that's what I think was going on. But again, why did the Fed have to? I think they were saving somebody. I don't think it was about, oh, we need housing to go through the moon so everybody feels good and they have more, money, cash out refis or anything like that. I think they were saving somebody who was having to sell and they jumped in the market.
I think it wasn't just saving somebody. I think it was saving everyone in the private mortgage market. I forget the names, but I know there were some not even high profile failures because there were small mortgage REITs, but mortgage REITs that were down 80% in a day because the liquidity like banks in 2008.
Right.
Fortunately, banks don't do this anymore, but mortgage REITs do. They rely on repo financing. And the refinancing was just gone. It didn't get more expensive. It didn't slowly disappear. It was just gone. Yeah. And, something like Annaly, which is, a sort of a best in breed, well-respected, very large mortgage REIT. They're still struggling to reach the prices that they were in 2019. I think they did in 2021, but, something down 80% as interest rates rose and, fell. And that's just because repo financing froze. So look, there's some great books about March 2020. Nick Timoros's book, $1 Trillion Triage, very good. I'm actually now reading Adam Tooze's book, Shutdown. And it's just, the Federal Reserve, it was a chaotic time. If you are, the ruler of a village and you think that it's your entire, village will just be gone, like you're going to do some pretty drastic things. You're not going to be worrying about, 3 years from now, this is going to cause this problem,
I wish they would come out and explain that because they did it on the backs of the banks, essentially. Well, anybody who is invested in mortgage pools, mortgages, they took the brunt of the problem because they were forced into those. There's nothing else to invest in. And these are government-backed, securitized mortgage pools. So it's super high quality. That's all they could invest in. There was nowhere else to go.
Right.
And then you put me there for 2 years. Everything that I own on my books reprices. Everything, meaning my loans, all reprice. All my securities reprice. Okay, this is what I got. And now all of a sudden, inflation becomes an issue. You ramp up 500 basis points. I do question whether that was proper. Like, there's going to be a lag. It's going to take time for that to work. Why not go to 3% and say, hey, we're going to hang out here for a while because, we got to give it time. It takes time. But I don't know if it's political pressure or if it's their models or I don't know what it is. But and then we're going to go, things are breaking. Okay. We've been talking about this for a year. They are now breaking and we're still going to raise rates again tomorrow. It's just...
Right. But Randy, isn't the fact that the Federal Reserve bought mortgage-backed securities, the vast majority, not vast, but the majority of which are still on their balance sheet because they buy them and then they stopped prepaying. So they're still there, and that's why people were talking about the Fed's balance sheet isn't moving down a lot in September.
It's not.
Wasn't the Federal Reserve kind of shielding the banking system from those losses? Wouldn't it have been far worse if those mortgage-backed securities were still on the bank balance sheets of commercial banks, and then interest rates went from 0% to 5%?
No, because what they did is they forced the replacement of all their assets to be replaced at much, much lower yields. The banks, you can't just sit on cash. That's not how the bank works, right? So what they did is they by buying into the mortgages, and not all of them, I mean, they bought enough to force the yields down, so low. I mean, basically 30-year 1.5s were going for par. 30 years. I mean, that was the market.
30-year maturity,
mortgage.
1.5 coupon.
1.5 coupon was for par.
I mean, it's a good deal when the 10 years at 50 basis points.
When your deposit's zero and you're making it's actually not even a good deal there, but
it's not a good deal. Yeah.
If they've got, I mean, they'd rather do loans, which they did, but the Fed spent 2 years forcing the repricing of most assets. And there's nothing this industry could do but to invest in those assets. There's just nothing they could do. Now, surely you can look at FRC and First Republic and say, hey, in this environment, is a 10-year IO a good idea? Probably not.
Yeah.
Because that's a longer duration. And that means the longer the duration, the more severe your price will be impacted when rates go up. So, but that was their model. That's how they got their money. And again, is that why they failed? Absolutely not. It was a bank run, end of story. Could they have survived it if they had done lending a little differently? Yeah, there's probably lots of things they could have done in hindsight that could have made them more robust and given them time to survive this environment. And most banks are in that category. They're not leaning into any one thing or another, and they've managed their cash flow, and they'll manage their cash flow going forward. They'll be okay. Will there be others? God, I hope not, but I'm afraid there will be. And it's going to be something we hadn't thought of, where, again, I've got my ideas, but I hate to put a target on anybody's back. But people talk enough about CRE that I'm not telling anybody that they don't know or already know. CRE is going to be a problem. If you're heavy in office, I suspect it's going to start getting some attention here sooner or later. Right.
I think I know the name that you're talking about with commercial real estate, but I'll
not really. It could be anybody. It isn't anybody in particular. Honest. It's
earlier you said you wouldn't name the name. I thought I knew.
Well, actually, no. What I won't. There's actually other exposures that some banks have. I'll give you one because I don't think it's a big secret. And this is what I wanted to ask Chris about it. So we'll have to try next time. If I think maybe what we might find out with FRC, one of the problems I think they ran into is they ran out of borrowing capacity because they were 95% loan to deposit. And so the BTFP, which is, by the way, the greatest lending facility in the history of man. I think we're so used to these mnemonics and all these programs and facilities that they just come and go and nobody even thinks about it. The BTF lending is extraordinarily awesome terms.
Right, Randy, and just for the folks at home, FRC was the ticker for First Republic, which if you look it up, it says it's still trading for $3.51, but it's not. It's not. And then BTFP is the bank's term funding program. The Federal Reserve initiated that 2 days after the fall of Silicon Valley Bank, where they can fund themselves at par. So an asset trading at 80 cents on the dollar, they can get $100 for it. And the funding, I learned this from you, the funding rate changes. So if the BTFP rate, which is a 1 year overnight index swap plus 10 basis points, is 4.8%. The next day is 4.7%. You can refinance.
Right.
Because although people don't like using the word refinance because
it's kind of not that, but it is. What I call it's a floating cap.
It's like being long an option.
Yeah. Well, it's like every time that it goes lower, I can now make that my cap. Which means that's the highest it goes, meaning that if I have a client with a 430 right now, and if the rates go to higher, doesn't matter. He's capped out at 430. If they go to 420, he calls up and says, I want the 420. They're like, you're good.
It's like when you own a callable security and you're exposed if interest rates go down, right? Right. Yeah. Then it's like the opposite of that. It is. Yeah. Yeah. It's a perfect hedge.
It's sort of like a put. It really is. You have the ability. Hey, anyway, that's never been done. I've never, ever heard of a loan like that ever in the history of finance. And you can do it at par. So really, meaning you don't market value was normally how you do, if that's my collateral.
That's the discount window. Yeah. Right. Haircut.
And FHLB. And so they both lend to par value. Well, so if it's to market value, if it's 80 cents on the dollar, we're only going to lend you 80 cents. And by the way, we're also going to haircut that another 10, 15, 20%. That's how they lend.
Hey there, sorry to interrupt. A lot of Forward Guidance listeners are not into crypto. If that's you, please skip ahead, get back to the interview. Some Forward Guidance listeners are into crypto. Some own crypto, a smaller percentage owning lots of crypto, and a much smaller percentage work at crypto hedge funds. If you're in those latter two categories, Blockworks Research might be a good fit for you. Blockworks Research is a research and data platform that analyzes governance, tokenomics, and models of interesting crypto projects, including new protocols. There's a lot of edge that can be gained from reading these reports. You can check out a sample report at www.blockworksresearch.com/research and hit the free report toggle. If that is of interest, full subscriptions can be purchased at www.blockworksresearch.com/sign-up. You can also get 10% off using the discount code guidance10. Thanks, and let's get back to the interview. And Randy, let me just throw these numbers out that I just pulled up in front of me. As of March 31st, First Republic, FRC, had deposits of just over $105 billion. It had borrowed $16 billion from the discount window, and it had done $2 billion via the BTFP. These numbers actually seem a little low. Actually,
those seem a little low. And okay, so this helps me make my point. They can't go to the BTFP that much because I don't know what their bond portfolio was. It was like 16 billion or something like that. Maybe not even that much. It was a really small bond portfolio. So I got to borrow $100 billion. My portfolio that works for BTFP, because it has to be, they only accept basically government securities.
Oh, right. Yeah. You cannot pledge mortgage individual whole loans to the BTFP, only securities. Yes. And You're exactly right. Yeah. I think it's a little, as of like December 31st, I think they own a lot of municipal bonds. I think a little larger than 16 billion, but not large by any means compared to its assets.
Right. So they had to use their loans to go to the home loan bank and the discount window. They can't get par, and there's a haircut on top of the market value. So my thinking is, and we may never know, I think they just flat out ran out of borrowing capacity. So had BTFP existed, by the way, with Silicon Valley Bank, who had a much larger percentage of a bond portfolio, they might have survived.
They could
have just gone to the BTFP and gotten par, and it would all have been fine. But they had to sell because there was no BTF program. And by the way, their AFS portfolio was very conservative. It was still a $2 billion loss, but it was a very conservative portfolio. And that got the whole ball rolling. My point being, though, is I don't think the BTFP program is going anywhere. They say it's temporary. I'm not sure. I think it's going to be around forever. And my guess is that banks, if you're a super high loan to deposit, I think that might get frowned upon. That you need good collateral for the BTFP program. So in case you need it, it's available. So you need that collateral. So that's somebody I think I might be worried about. If I was a bank with a really high loan to deposit, I'm probably going to back off that. I'm going to probably say, hey, you know what? We're going to build probably cash first. And then when we have enough cash, we're going to start building a short duration, well-structured cash flow wise bond portfolio. That way, if we ever need to borrow on BTFP, it's available.
Right. And those single mortgages, they cannot be pledged to the Fed under the discount window or BTFP, but they can get access to the Federal Home Loan Bank, which really, people talk about the Federal Reserve. Obviously, Federal Reserve, incredibly important. But when you talk about, dollars and cents, how much funding is received and aid is given to the banking system, the Federal Home Loan Bank is so much more money has been given over the past month or so than the Federal Reserve. It's not even close. And I think they now have over $1 trillion in advances, which are a variety of maturities. And I'm actually going to go with what I found yesterday. I think FRC had $77 billion in borrowing from 63 from the discount window, 13, 14 from the BTFP. And then they also had a lot from the bank term from the FHLB. And I think that is why the FDIC is doing this whole $50 billion thing that the CFO did not want to disclose the yield of.
I think so too. I think that's basically, we're saying, hey, to wipe out all those borrowings at 5%, we're going to give this to you at 2%, or like you said, 350, wherever the 5-year is, so that way they've got a spread. All the assets they just took that they got at good market value, so that's probably 6-7% yield. Instead of you sitting at this 5% borrowing level, we'll take you down to 3.5%, right? So you're protecting your net interest margin, if that makes sense, right?
Yeah, that makes sense.
Yeah.
So what have you seen about the FDIC's new and proposed rules that it wants to enact following this? I just was looking at this as we started. The FDIC outlined 3 options for deposit insurance reform. Number 1, limited coverage, maintaining the current deposit insurance framework, which provides insurance up to depositors up to a specified limit, possibly higher than the current $250,000 limit. Yeah. Number 2, unlimited coverage. Okay, we know what unlimited coverage means. Everyone's insured. Number 3, targeted coverage, offering different deposit insurance limits across account types where business payment accounts receive significantly higher coverage than other accounts. Okay, so option 1, increase the cap from $250,000 to some
probably
higher
$1 million.
Number.
Probably $1 million.
Probably $1 million. Number 2, everyone's insured. It's a total giveaway to depositors. And number 3 is, individual accounts are insured up to $250,000, but business accounts are insured up to $1 million.
Yeah, they're going to change that to some degree. And actually, you might not have seen it. You go track it down. The New York Research Department, New York Fed Research Department, they came out with something basically, how can we prevent uninsured deposit flight? And it talks about penalties. It talks about, if you take out a certain amount of money, you've got to wait 30 days to get it. Or so, it was something, crazy. If you take out more than a certain amount or whatever, trying to think of a way that they could prevent the speed of withdrawal that we just saw. So that's throwing it up there. But yeah, they're going to come up with something. Everything 100% insured seems crazy, but so far, everything's been 100% insured, right?
Yeah, the regional banks had a proposal maybe a few weeks ago that all business accounts or maybe all accounts are insured for like 1 year or 2 years, so it gives banks time. Just going back to Chris's point on time.
That's possible. I mean, that wouldn't give somebody nefarious enough time to do really dumb things with knowing that, hey, the deposits are 100% insured, so now I can really go crazy. And I think that's the idea of not 100% insured, is that, if you're a large depositor, like I got a friend who runs a very large real estate firm. When all this went down, he called his bank and said, talk to me about your bank portfolios. What's your unrealized losses? What does that look like? What's your duration? That is what you want. You want eyes on the bank. If you've got, a couple $1 million or more in a bank, you better be paying attention.
Right. But Randy, I'm biased from my previous conversation with Nathan Tankis, but so it sounds like your friend very sophisticated in areas of finance. He works in finance. They work in finance, but most business people, including very sophisticated, successful business people, do not have the wherewithal to the sufficient knowledge to analyze oh, what happened to a mortgage, $100 billion mortgage book when the coupons, coupons went up? And the idea, I mean, look, incredibly smart people in Silicon Valley. They're really smart in technology, healthcare, all these types of stuff. They have no idea what we were talking about right now.
100%.
Yeah. And
he didn't know either. He had to ask me.
Depend upon them, and everyone, like as someone who runs a boat shop and is very successful, like they don't have to,
Yeah. No, that's true.
Yeah.
No, I totally agree with you. And by the way, he had to ask me what this is what they told me. Oh, okay, well, this is what it means.
Yeah.
So you're right. Absolutely. But I mean, that's the spirit of it. But, I don't know what's going to happen with that. I mean, we've already proven, I mean, it's, Signature and Silicon Valley Bank and effectively, First Republic, it was all 100% insured, right? No depositor lost any money. So,
right.
Because they're it's systemic, or what does Yellen use? It was
systemic risk exception. Yeah.
Yeah. And man, that's, how are you going to, I don't know how you're ever going to pull that back in if you have another bank failure and you're going to
and the reason that FRC depositors are going to be fine, including the uninsured depositors, is not because the FDIC extended the cap to insurance uninsured depositors like they did for Signature and Silicon Valley. It's because they got taken over by JPMorgan. Randy, we've been talking. It's been great getting your perspective. As people can see from the screen on Twitter, you're at the Bond Freak. People need to follow you. You've got tons of insights. If people somehow get on your email distribution, that is highly valuable, definitely for insights into banking. Just to give people a sense of just what forward guidance is got over the next, let's say, month.
It's incredible.
Perry Merling, worked a lot with Zoltan Pozar. He's coming on very soon, actually.
You got Zoltan coming on? Or no?
Perry Merling
with
Zoltan. Yeah. Jim Bianco's coming on FOMC Day. The day after FOMC, Nick Timros is coming on. I'm talking to Michael Pettis. Sheila Bair, former head of the FDIC. I'm
excited for that one.
She's coming on later.
She doesn't hold back, man. You're going to get a lot of good feed. All those people, they're all wonderful. I saw that list this morning. I was like, holy crap, that's awesome.
Yeah, no, I'm pretty excited. Yeah. Well, Randy, thank you so much. And do you have a parting message you want to leave our audience with?
No, I would say the only thing, Jack and I we're working on getting one of my internal guys on, hopefully on us three, that is even more unique as far as, the ability to see what goes on in banks as I do with portfolios. He does with loans, and there's even fewer of him. And when we get that out, man, that is going to be a really, really unbelievable education for everybody, because those people you rarely get to hear from. So I'm really looking forward to that.
Me too. I'm not going to reveal a name, but it was you quoted in an article, and I saw this person is fascinating. I love to talk to them, and I saw you worked with Raymond James, and so I reached out to you, and that hopefully will air next month or so. Randy, thanks so much for coming on, and thank you, Chris, for coming on, and thanks everyone for watching. Talk soon. Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.